A large segment of the United States is currently in denial about whether or not we're in a recession. And almost everyone who is denying we're in a recession is saying the reason we're not in a recession is because the labor market is strong.
Very strong labor market.
The very strong labor market.
The employment rate is still one of the lowest we've had in history.
That would point to the labor market.
Given how strong the job market was.
The labor market is now extremely strong.
Resilient, strong labor market.
We have a strong labor market.
But the problem is, no, the labor market is not strong. The labor market is broken. What's up, guys? I'm Nobody Special, and today the numbers came in confirming what we all knew already, that the U.S. is in a recession. 2 consecutive quarters of negative economic growth is the textbook definition of a recession, even though the press is circling the wagons right now, insisting that we're not in a recession because the labor market is strong. But the problem is, they're saying the labor market is strong because they're only looking at one side of the supply and demand balance that makes up the market. You see, in a market, you have buyers and you have sellers. Now, historically, we have viewed the labor market as strong as long as there was enough buyers of labor to satisfy all the sellers of labor. In other words, we called it a strong labor market as long as we didn't have really high unemployment. As long as there was enough jobs for everybody who wanted a job, the labor market was strong. And undoubtedly right now, there is a job for just about everybody who wants one at the current going rate. And that's the asterisk that nobody is paying attention to. Nobody is looking at the job market from the business owner's perspective right now. You see, every market has sellers and has buyers, and where supply meets demand, that's where price is. Every market functions that way, and labor is no different. Well, what do we have right now in the United States? There are over 11 million job openings in the United States, and these openings have been there for a while, and there's nobody to fill them. At least nobody is willing to fill them. We have millions of people who have left the workforce. Check out this chart of labor force participation rate, and you can see that since 2008, the workforce participation rate has gone down, even though the population has gotten bigger. There are fewer people working as a percentage of the population now than there were 10 years ago. People are leaving the workforce. Why? Because it's not worth their time. The price is wrong. In other words, the labor market is not functioning properly. So no, it's not a strong labor market. This is an incredibly weak labor market. Our economy needs more employees, but the people who could become prospective employees are not willing to work for what the economy is offering to pay them. So what's the natural solution? The natural solution is for those wages to go up. Now, I made this video a couple of days ago about how Jerome Powell is trying to kill the job market right now. Jerome Powell is trying to make those 11 million job openings go away without the price of that labor going up. You see, Powell and the people running the Fed, these are Keynesian economists. And Keynesian economists believe in 2 kinds of inflation. They believe in demand pull inflation, where there's an increase in the money supply, creating more demand for goods and services, and thus the price of goods and services goes up. That's the demand pull inflation that the Keynesians are always creating with their loose monetary policies and their low interest rates and the credit expansion. But the other side of the inflation equation for the Keynesian is something called cost push inflation. And that's where the input costs of economic activity go up, and therefore the business owners increase their prices. So when things like, let's say oil get more expensive, or when wages go up, that would create, according to the Keynesians, cost push inflation, and the business owners would have to pass those higher costs on to their customers, creating an endless cycle of wage increases and price increases, causing more wage increases, and on and on and on. So what the Keynesians have done for the last 50 years is every time we've had a little bit of an inflationary period where we get the demand pull inflation, where because of their credit expansion, you see the money supply increase and asset prices start to go up. As soon as that starts to translate into cost push inflation, where wages would rise, that's where the central bankers put on the brakes. Now, the result of that after 50 years is actually quite catastrophic for the average working person. You see, you have to look at the way inflation hits, and there's a very specific order that it hits. The first thing to go up with inflation is always asset prices. People get extra money, and what do? They buy stocks, they buy bonds, and now they buy cryptocurrency, they buy real estate, and that's when you get things like a housing bubble or a crypto bubble or any number of the bubbles we've had over the last 50 years. And you know what? The central bankers were okay with that asset price inflation caused by demand pull inflation. Again, we're thinking like a Keynesian right now. This is okay because the wealthy get even richer when that happens. See, the wealthy tend to own more stocks and own more bonds and own more real estate. And so the wealthy see the benefit from that demand pull inflation and they get richer and richer. Now, the second thing to be hit by inflation is consumer prices. That's when the cost of food and the cost of goods and services starts to go up. Now, again, this helps the wealthy because they own the businesses that sell those goods and services. So still the Keynesians are just fine, and the central banks, they're just fine with this inflation. But the last place that inflation gets hit is in wages. Notably, private sector wages are the last place where the inflation shows up. And all of a sudden, it's a problem for the Keynesian economists. Now we're into cost push inflation. See, now it's not acceptable. You see, up until this point, the little guy has watched his rich counterparts get even richer. He's sat it out because he doesn't own the assets that first inflated. And then the little guy paid the price because he had to eat the cost of the higher goods and services, the second place that inflation got hit. So now his standard of living has gone down. So what does the little guy start to demand? He starts to demand a higher wage. This is when the Keynesians slam on the brakes. This is when the central bankers start tightening monetary policy and they start raising interest rates to make sure that the little guy never gets that raise. See, the Keynesians are all about creating inflation until it starts to help out everybody. And that's why I made that video about Jerome Powell trying to kill the labor market. And that's why I was getting so upset during my live stream of Powell's press conference yesterday, because now they're so desperate to slam on the brakes after last year when they watched the stock market surpass the previous high from before the pandemic. And yet they kept pumping money into the markets, further inflating asset prices, making the rich even richer, including themselves. Remember, they sold their stocks in August, just before the all-time high in the stock market. But now that there's an imbalance in the labor market because of the Great Resignation, because people are refusing to work for the wages that are being offered, now the Federal Reserve sees a problem. Now the Keynesian economists see a problem. Now they need to put the brakes on it. They use soft words like lessen the demand for labor, or reduce some of the tightness in the labor market, or bring supply and demand back into equilibrium. What they're really saying is they need to kill jobs before wages go up. You see, now that the wealthy have seen all the benefits of this inflation, and now that the benefits are starting to trickle over into the poor who have so far suffered from inflation, and their standard of living has been brought down because of it, now that they're finally in a position to recover some of that, Keynesians are going to slam on the brakes and crash the economy. And with that, we are going to shrink my big melon of a head. And this is what 50 years where they create inflation, and right before it reaches that cost push segment of inflation where the wage earner begins to finally catch up a little bit and they slam on the brakes. After 50 years of them doing that, this is what we get. And this is a website everybody should have bookmarked at some point in their lives. This website is called WTF Happened in 1971. 1971 is when the United States went off of the gold standard and when the era of true fiat currency began. That's when Keynesian economics began to morph into modern monetary theory, and when the era of easy money made the wealthy incredibly more wealthy at the expense of the poor. And this is all of that class warfare and all of the political heated rhetoric, and the ugliness of modern politics can trace its roots into a lot of these charts at WTF Happened in 1971. Now look at this first chart right here. Growth in productivity and hourly compensation since 1948. And you'll notice from 1948 right up until 1971, you'll see as the average worker became more productive, the average worker's salary rose to a commensurate level, which means workers saw a share of the increase in productivity. Everybody's life got better. The rising tide lifted all boats. But then in 1971, look at how the wages suddenly stopped increasing, even though the productivity of that worker kept going up. Why? Because they created this inflation, and then after 1971, the average worker stopped seeing any of the benefit caused by the increases in their own productivity. All those benefits went to the asset owners, the super wealthy who owned the companies that they worked for. Every time the wages started to go up, they would slam on the brakes in the economy and suppress the prices of their work. And after 50 years of that, you can see we've got a 246% increase in productivity. That is the economic value that has come out of that labor, even though the cost of that labor has only gone up by 115%. You want to know why we have this big gap between the rich and poor? Look at this chart and look at 1971 as the point where those two departed. And what happened in 1971? When we went on to a fiat currency standard. Now, folks, I could stick around on that WTF happened in 1971 page all day and just show you these charts and what it's meant and just the absolute misery of the middle and lower classes that has been unleashed in the United States because of this constant state of inflation that we've been held into. And yet the second that inflation reaches wages, the central bankers have artificially slammed on the brakes to make sure the poor never see any of the benefit. All of that benefit has been concentrated at the top. It's not because of tax policy. It's not because of institutionalized this or that or any of the other reasons that are used to divide us into groups and make us hate each other. No, it's the monetary policy that has created this endless inflation that has been weaponized to destroy the middle class. Piece by piece, bit by bit, the death of 1,000 cuts over 50 years, to the point where we're right here at a point now where we're starting to see wage inflation. Wages haven't really gone up yet, but the fact that there's 11 million job openings in the United States, those wages have to rise in order for people to fill those jobs. And right now, look at what the Federal Reserve is doing. They are desperate to slam on the brakes before that happens because they can't allow their cost push Keynesian inflation. They can't let people make any more money. Inflation is about making the rich incredibly richer. It's about not letting the poor have an out, destroying their upward mobility, destroying their quality of life. It is the road to serfdom that Hayek warned us about. So remember that the next time somebody tells you we're not in a recession because the job market is strong. No, the job market is broken. The job market is incredibly weak. Ask any business owner. He can't find help. And because he can't find help, there's no economic activity happening with those jobs that are going vacant. And that's why GDP is shrinking. That's why we're in a recession. If you want to know more about what Jerome Powell is trying to do to the jobs market, you can check out this video that I did just a couple of days ago. Until next time, live small and dream big.